be in the chat, so you can copy that link and text it or message it or email it to anybody you'd like. So with that all being said, we'll go ahead and get started with our presentation for the evening.
Yeah. Thanks everybody for attending. We are Lee and Megan Fjord with the Make It Happen Multifamily webinar series. So to go into a little bit further about who we are, we have a company called Green Forest Capital. We are real estate syndicators. We are full-time real estate syndicators, and our company, we founded a group called Make It Happen Multifamily. It's a real estate networking and educational group. We are on Facebook. We've got our YouTube channel, like we just talked about. We do live events in the St. Louis area called Tours and Pours. Our next one's coming up, I think it's like the 26th. What to see? It's usually the third Thursday of the month. We are still looking for your featured owner for that one. So if you're local to St. Louis and you have a multifamily building, we'd love to chat with you.
Yeah.
But yeah, we started doing these really to help educate folks, really help, help people network and just not be afraid to go bigger. So yeah, with that being said, we also love learning and leaning from the advice and amazing knowledge of our guests in our network. And our guest for tonight is Dave Mitchell, cost segregation study expert. Thank you so much for joining us tonight, Dave. Tell us a little bit about yourself.
Yeah, Lee and Megan, thanks for having me, and I'm honored to be here speaking in front of everybody. ETS is a national leader of specialty tax incentives. So what we focus on is helping real estate investors use all the available programs to minimize their tax liabilities. We've been doing this for over 20 years. We work with CPAs across the country and clients of those CPAs. And we're licensed to perform work in all 50 states. So it doesn't matter where the property is located, we can help out. And as part of our services, we also offer full audit defense on our work. So we stand behind what we do. And that's important to give you some peace of mind that, we're there to help if there's any questions that come up down the road. We're there to answer those for you.
Yeah. And we'll just have to, really give Dave and his company props because he's done all of the all the cost segregation studies for our properties and our multifamily portfolio. And it's always been an awesome service, very professional, very timely. He's been a great partner to have. So yeah, definitely keep his information in your back pocket if you see yourself needing a cost seg in the future.
I love it when I can reach out directly to the people I'm doing business with. And, Dave always picks up the phone or immediately calls us back. He's an industry leader. He knows, so many more details about his specific niche, which is so important. In our business, we love partnering with and doing business with people that are specialists.
Yeah.
And Dave is that.
That's right.
Yeah. And Lee and Megan, you've been great clients. Part of my job is just the education piece, because there's so many real estate investors that are either new to investing or they just haven't heard about the tax benefits of doing programs like cost segregation. So a big part of my responsibility is just bringing that education to the market and making sure that you're keeping as much of your investment money as possible. We always say that, we think everybody should pay taxes, but you shouldn't have to leave a tip as well.
Right. Absolutely. And that's one of the best benefits of investing in real estate. Whichever way you end up doing it, passively or actively, if you're an owner of real estate, you can participate in this. So this is going to be really exciting for you to understand what that K1 at the end of the year actually means and how this cost segregation study affects that. So with that being said, break it down for us. What exactly is depreciation, Dave?
Okay, so really cost segregation in the kind of a simple illustration here, if you look on the left-hand side, when you have a building, when you own an investment property, whether it's commercial or residential, that with straight line depreciation, which is the normal process of depreciating the asset, for a commercial building, that's depreciated over 39 years. For a residential rental property, that's depreciated over 27 and a half years. For this example, I'll show a commercial building. And with straight line depreciation, the entire building is looked at as one asset. And then the depreciation basis, which is basically the purchase price with the land value backed out, gives you the depreciation basis of that asset. Through straight line depreciation, it's depreciated evenly over 39 years. So you know exactly what you're going to get for depreciation each year over 39 years. Well, the IRS understands that not everything in that building is going to last for 39 years. You're going to replace flooring, cabinets, carpeting, fixtures. And what they've allowed is something called the maker's depreciation method, which is modified accelerated cost recovery system. And through the maker's method, they allow you to itemize or put into different buckets of quicker depreciation some of those assets that don't last 39 years. So there's a 5-year bucket for inside assets like the flooring, the cabinets, lighting, fixtures. Those are all considered 5-year depreciation assets. And then there's a 15-year bucket for outside assets, things like landscaping, signs, outdoor lighting, awnings, those types of things can be put into a 15-year depreciation schedule. And then the remaining components are kept in the 39-year depreciation schedule. So structural components, the roof, windows, those types of things would be kept in the 39-year depreciation schedule. So basically, it's just a change of depreciation schedule that allows you to speed up the depreciation write-offs on the building rather than having them spread out over 39 years.
Right. So basically, to summarize a little bit of what you said, so you take your cost basis, you divide that over 39 years for this example, and bam, that's straight line.
Yep.
And what that means is basically that amount, whatever your cost basis divided by 39, is a loss on your taxes because you're a real estate owner each year.
Yep.
Correct.
Yeah.
And then
it's a write-off that you can apply to your income. So it's a tax deduction.
So you're not actually losing anything.
Nope.
Yeah.
You're not
Paper
losing
loss.
anything, but it's a paper loss, which is amazing. That's one of the great things about real estate.
Dave, I have a question. We specifically focus on multi-family properties that are of commercial size, 5 units or more.
Yep.
Is that over 39 years or is that a residential?
Yeah. So the multifamily is considered commercial. So it'd be 39 years.
Okay.
Single family houses, rental houses, it has to be on your tax schedule to qualify. So a primary residence wouldn't qualify. But if you had a single family rental house, that would qualify. Typically those for a long-term rental would be treated as a 27.5-year depreciation schedule. If it's a short-term rental like Airbnb, something like that, that's considered commercial. So it's a 39-year depreciation schedule, even though it's a residential house.
That's interesting.
Yeah, that's a new one for me.
Yeah.
Okay.
You learn something new every time we do one of these things.
Yeah.
So that's awesome. So yeah, let's move on. So yeah, you just kind of talked about this, but
yeah, just to kind of expand more on, what cost segregation is. We're not, applying new depreciation or adding depreciation into the number. We're using the same depreciation basis as you would with straight line depreciation. We're just doing an engineering study that breaks down all of the different assets in the building and puts a number to those. And that allows you to change your depreciation method to that quicker depreciation. And, I get a lot of questions from people that aren't familiar with cost segregation. They ask, well, why didn't my CPA bring this to me? Is this legal? And yes, it's completely legal. It's been around since the 1940s, and it's actually the IRS's preferred method because it's obviously more detailed. A lot of CPAs, they just don't have the bandwidth to do the engineering. So it's something where they either farm it out to somebody like ETS, or they just don't recommend their clients doing it. A lot of CPAs also have a misconception that it has to be a $10 million large office building for it to make sense. And I've got clients that have $180,000 rental houses that they're still seeing really good benefits on. So there's just a lot of misconceptions and understanding of what the benefits are. So if your CPA hasn't brought this to your attention, it's probably just because they don't do it themselves, and they might not have experience with it, but they should all understand the basics of it.
Right.
Again, it's the cost segregation is the actual study where we're reviewing the asset and putting a number to each of the components, and changing the depreciation schedule from straight line, which is either 27.5 or 39 years, and itemizing out basically the personal property and putting that into the 5 or 15-year class life. So why would somebody do this? The first is, just to get that tax benefit through accelerated depreciation. We typically, as a general rule, we're able to reclassify about 30% of the building basis into the faster depreciation classes. So that's going to give you a pretty nice increase in cash flow and obviously reduce your tax liabilities. There's some side benefits as well above and beyond the tax benefits that you get right off the get-go. Because we're itemizing out each of those individual assets, you now have the ability to optimize write-offs for repairs and maintenance, or if you retire an asset, such as, let's say you replace a roof, through straight line depreciation, there's no way for you to itemize out what the old roof depreciated at. So because it's all considered one building, you can't really do anything with that. After you do cost segregation, there's a specific number tied to each component of that building. So if you replace the roof, your CPA can then write off immediately the old roof that you took off. That way you're not carrying the old roof and the new roof on your depreciation schedule. Same thing for, something simple like let's say you take out a chandelier. Prior to doing cost segregation, there'd be no way to write off that specific fixture. With cost segregation, there's a number tied to that chandelier, all the wiring behind the wall, all the wiring for the light switch, everything is detailed out. So when you make internal renovations as well, those can the old assets that have been removed can immediately be written off, and it just increases your deductions for that year.
Yeah.
One thing that we do a lot of at our properties is we do heavy lift CapEx projects in general. So, for example, our deal in Atlanta, we plan to remodel 86 apartments, and they're going to get all new kitchen cabinets, all new appliances. We're going to rip out the kitchen and basically throw everything in the dumpster. So what I'm hearing is that we can purchase the property, we can realize the depreciation for those assets on the front end, and then we can throw them in the dumpster, and then we can go buy new assets and add them to our depreciation schedule.
Exactly. And we can do an improvement study on the renovations. So that way you get the accelerated depreciation on the new assets, the new cabinets, the new flooring. And yeah, it's a win-win.
So those new, what pocket or what bucket do cabinets fall into? Are they a 5-year thing or are they a 15-year thing?
Yep. So anything inside the building is can be reclassified as a 5-year that isn't structural. And then outside components, landscaping, fences, sidewalks, awnings, signs, all that kind of stuff is considered 15-year property.
So we can also write those off as we buy them after we've already depreciated down to zero or almost zero a large number of those items. Yeah. Old cabinets, we're just thinking about this one project. So old cabinets, we depreciate them, with bonus depreciations 80% today.
Yep.
And then in the future, we go buy new kitchen cabinets, we throw them in there. They, if it's in 2024, it'll be what, 70% because it drops by 10% a year.
Yep. 2024 is 60%.
60.
And I've got a slide that'll show that, but
all right. I'm getting ahead of ourselves.
Yeah, you're jumping.
Keep doing it. Yeah. We'll let you, we'll move on to the next slide. And
yeah, we have a couple questions, but we've only got a couple of slides left for Dave. So we'll get to those real at the end. So
yeah. So Lee, you brought up bonus depreciation, and basically what bonus depreciation is it's kind of cost segregation on steroids. In the Tax Cut and Jobs Act of 2017 was an area that allowed all of the 5-year and 15-year reclassified assets through cost segregation. They would qualify for bonus depreciation, which gives the owner the ability to use those, everything in 5-year and everything in 15-year. They could write that off in year 1. So it's a huge benefit for investors, because now rather than having, obviously you get benefits without bonus depreciation before 2017, but that 30% typically that we're able to reclassify of a basis can be written off in year 1. So $1 million building basis, you could have a $300,000 write-off in year 1, which was a huge effect. So for 100% bonus depreciation, it ran from basically the end of September of 2017 through the end of 2022. Unfortunately, there is a sunset clause in there where they're phasing it out 20% each year until bonus is gone in 2027. There's a lot of talk within Congress, and we have lobbyists. Our executive committee works with the tax and real estate roundtable. Obviously, there's a lot of people that have a vested interest in making sure that bonus doesn't go away. That's to be determined. But as of right now, these are the rules that we have to play by. So, for example, if and the date is all based on the purchase date or the placed in service date. So, for example, if you bought a building in 2023, you would get 80% bonus depreciation. If you bought the building in 2024, that would go down to 60% bonus depreciation. Any questions on that, Lee?
We have this project that we're, in Atlanta, and we are going to close that deal in this year specifically so that we can make sure to maximize bonus depreciation at 80%. I know that it's always been in existence, even prior to 2017, cost segregation studies and this process, but the bonus depreciation has just been an added bonus.
But that's a good point to bring up, though, and I know this is a question that we get from a lot of our investors, is even if we close in December and we haven't owned the asset for the whole year, like we still get all of that depreciation in year 1?
Yes. So with straight line depreciation, the depreciation write-off is prorated based on the purchase date. So if you buy something in December, you get 1/12 of the year's depreciation. Mm-hmm. With cost segregation in the maker's method of depreciation, there's no proration of it. So you get the full year's depreciation regardless. I have a lot of clients that, they're looking to minimize their taxes, and they're, making purchases at the end of the year specifically to do cost segregation to apply to that year's tax return.
Yeah. And so we did have a question about recapturing too. So, this depreciation, when you sell, you have to recapture the depreciation. Is that what you've seen? Is like some people, they'll specifically buy something in the year that they're recapturing so that they can use cost segregation again and knock that back down?
Yeah, so with recapture, you're basically taking an advance on future depreciation with cost segregation and the maker's method. So there's some instances where cost segregation just doesn't work well. One of those would be if you're buying something and flipping it within the same year. Obviously, you get that depreciation write-off, then you'd sell the building and you would owe that back. There are ways to limit that though. Um, there's 1031 exchanges where you can still take advantage of the depreciation write-offs and then reduce the new basis by what you've taken through depreciation and the old building. So that's another strategy to minimize the recapture, is using 1031 exchanges. And you can always also do most of my clients, when they sell a building, they'll buy another building. It's not like they're cashing out. They're real estate investors. So they're not just cashing out, they're putting that money into a new building, and they'll immediately do a cost segregation to help cover, capital gains, recapture, those types of things on the sale of the old property as well.
Nice. Yeah. Because that's one thing that we come across. We are syndicators, and our typical business model is a 5-year hold. So
Yep.
after 5 years, we're typically selling. And then, hey, we have that recapture event.
Yep.
But, we also, want to continue to buy. So, and it is very difficult to 1031 exchange out of a syndication because you have to keep all the same partners, and there's just so many
Right.
investors.
Right.
So, specifically with the syndication model, it's, might be best to just keep investing.
Yeah.
And if you hold on to the building for 5 years, I mean, that's a kind of a key area, because you're all of the 5-year assets had already been fully depreciated at that point. So you're not going to have any recapture on the 5-year bucket. It would just be 10 years worth of the 15-year reclassified depreciation would be the recapture. So it's minimized a lot in that effect.
Yeah, that's good to remember for sure, as far as when to decide whether we should sell early or sell on time.
Yeah.
Yeah, for sure.
Gary just put in a great question. Is 100% of the recapture taxes long-term capital gains?
Well, it all depends on what you do with, like I said, if you do a 1031, then that kind of, you kick the can down the road on that.
Yeah, assuming a normal
that would,
situation.
you'd certainly want to talk with your CPA on the specifics of that.
Yeah.
I'm not a CPA. I don't pretend to be a CPA.
Yes.
We work specifically with like the cost segregation and other tax strategies for investors. But we have to rely on CPAs to help us determine the client's best utilization of the deductions, and then the exit strategies when they're looking to sell the building and looking at the recapture. So
for sure, good to mention.
Talking with your CPA on the specifics of that.
Yes.
And we are not.
Yeah, Lee and I are
CPAs. We're not CPAs. We're not attorneys. We are just here to provide value and information when available. But holding it over a year, I would imagine, as long as you hold the property, you don't 1031 and you do sell and you do recapture, it would come in as long-term capital gains, I would imagine.
Yeah, selling a property long-term.
Yeah.
All right. So
just a couple other things on this slide is what types of buildings or purchases does it work on? And really it runs the full spectrum. So new construction, that's a great time to do it, because we get a baseline of what the building was at purchase. So in the future, if you do any renovations, we've got all those numbers broken out. We talked about renovations, existing properties, also leasehold improvements. So if, for commercial buildings, if it's a business that's going in and leasing the space, but they're putting in, they're doing build outs, things in the commercial space, you can get a cost segregation on those leasehold improvements. And then, like we had talked about with 1031 exchanges, selling a property with a large gain, those are all great times to look at cost segregation.
For sure.
Absolutely.
Nice. I'm going to get to your next slide so we can get to these questions.
So this one, hopefully everyone can see, but this is kind of a real world example of the benefit of cost segregation. This is one of my clients that purchased a $685,000 warehouse / office space. The land value was $137,000, so we back that out, and the depreciation basis is $538,000. So this column B would be what straight line depreciation would provide. So he purchased this in 2020. It was towards the end of the year, so you can see it's prorated. You got a little over $4,000 in depreciation expense write-offs, and then each year after that, you would get $14,051 for the next 38 years. With cost segregation, we were able to reclassify $140,000 into that bonus depreciation. So that's what the first year write-off would be. And then you can see every year thereafter, it would be a flat $10,538. So with cost segregation, you're still going to have write-offs in future years. You're just taking a portion of that in
Pardon my French. Go ahead.
You're just taking a portion of that. So about, $3,500 of the future years and putting that into year one.
Yeah, that's huge. Look at that,
$140,000 in year one versus, $4,098 that you get to be able to take on the front end. That is a game changer.
I'm sorry, there's a part that's cut off a little bit on here, but it just tells you what the difference is. So you'll see this person purchased the building in 2020. We did the cost segregation in 2022. So it doesn't have to be right at the purchase time. So they've obviously taken, $4,000 in 2020, $14,000 in 2021. So what we're able to do is
I'm going to actually pull up your slide for this. I got your other presentation up, so I'm going to actually pull that up for you.
Okay.
And then we'll show it. And of course, now it's going on the wrong slide.
Just change which screen you're sharing. Either way.
Oh, I guess I could do that. All right. I'm just going to show the presentation here. So it's not as pretty, but bear with us, folks. All right. This guy.
Yep. Number 6.
Oh, number 6.
There we go. So you'll see in 2022, when we did the study, the net benefit would be 128, almost 129,000, because we're doing kind of a look back study because it was done after the initial purchase, but that's still a huge amount. So even if this person waited for 5 years, you can see they'd get $118,000 as a write-off for 2025.
Yeah. That's good to know. Because I think a lot of people think that you can only do it in the first year, and that, if you don't do it in the first year, it's not worth it. But obviously that's the case.
That's kind of a big misconception. The next slide will go kind of walk through, this look back study. If you didn't do it when you initially purchased the building, we're able to go back and perform a study on prior year purchases and book that adjustment in the current year. So it's still a viable option, even if, you purchased the building 15, 20 years ago. Obviously, the benefit will vary based on the size of the building, the amount of depreciation that's already been taken. But what we do is we'll put together a free analysis for any prospective client that will break out what the expected tax benefit is, what our fees are. That way they have a really good understanding before jumping into anything, what the benefit is going to be. So Happy to do that for anybody that has buildings that they've held for a while. We can run numbers for you and show you what the potential benefit is for this tax year. Obviously, if you bought a building between 2017 and 2022, you qualify for bonus depreciation, even if you did cost segregation study this year, next year, the following year. Again, it's all based off when you purchased it and when it was placed in service, not the year that you're doing the cost segregation study. So you'd qualify for 100% bonus, which is huge. So if you did purchase a building during that time frame, I'd love to put some numbers together for you.
Yeah, I was just about to reiterate that for you. Is like, hey, like talking to you, if you bought a piece of real estate anytime since 2017, like this is something to look at for sure. 100% appreciation.
For those that bought something prior to 2017 and haven't done cost segregation, it's still beneficial, because basically you're still accelerating all of the 5 and 15-year numbers. And by now, all of that 5-year, you'll be able to take all of that we can reclassify in the next tax year. And, what is it, 8 years, 9 years of the 15-year deductions can be taken in the tax year.
Right.
So going back, if you decide to do a cost segregation study now and you've already taken depreciation in previous years, how do you file that? It's pretty simple. We can provide, or your CPA can provide, a 3115 form, which is a change in accounting method. And we'll do the 481A adjustment, which basically reconciles all of the previous depreciation that you've taken with the bonus depreciation or the accelerated depreciation that you were allowed. And that'll give you the number that you can use for the current tax year. The 3115 form and the 481A adjustment eliminate the need to amend prior returns. So it's nice and clean, very simple. Nice. However, some clients want to amend prior returns and apply that deduction to previous years. If you had a big tax liability 2-3 years ago, when you purchased the building, you can apply that and lower your amended return that way as well. So a couple different options on how to apply it.
Yeah, you might want to look at that for your Geyer property.
Yeah, a property that I sold this year that did really well, but I never did a cost seg on it.
So, yeah, and he gutted that entire building.
Well, I threw everything in the trash. Nothing.
Yeah. So awesome.
We've got one more slide. There we go. Passive versus active, and this covers one of the questions that just got asked. Can you explain what depreciation can offset? And I think that's probably going to cover that in this slide.
Yep, absolutely. So that's the big question, is how do we utilize the deductions? Generally, a limited partnership is an investment group. The investors would be passive investors. So the tax benefits from a cost segregation study are treated as a passive loss against that net income of the investment. The nice thing is the benefits of cost segregation, these deductions, can be carried forward for 20 years. It's not a use it or lose it type situation. So you can, eat away at this until it's gone in future years. So for example, let's say you had $100,000 worth of deductions from cost segregation, and the income from the investment was $10,000 each year. You could basically be tax-free on that income for 10 years because you can apply $10,000 each year. So it's a great tool to, like I said, help minimize your tax liabilities on these investments. Another option is if you can attain real estate professional status. That's kind of the best case scenario, because to get the designation, it's not a certification or you have to go through a course or anything. It's just basically something that your CPA designates on your tax returns, and then you have to be able to verify and prove in case of audit down the road. But you have to perform more than 50% of services in real estate. You have to have more than 750 hours per year in real estate, and materially participate in each rental activity. Again, I'm not a CPA. I can't give you specific, use cases, but these are the main criteria that are looked at. And realistically, my clients, what they do to adhere to this is just keep a log of your activity, so that, like I said, in case of audit down the road, you have a log of that you can prove your activity in these areas. And I'd recommend not doing it when you do get audited and trying to go back and using the same color pen, because that will get flagged. The benefit.
One of the other questions that came in just a moment ago is, can you explain what the depreciation can offset? So what's a good example of it? Let's just assume that they're not a real estate professional, for normal purposes. What's another example of a passive form of income, outside of the cash flows that you receive from your invested dollar into a syndication?
Knowing that you're not a CPA.
Knowing you're not a CPA, none of us are.
So typically the passive loss offsets passive income from that investment property. Mm-hmm. So if you do have real estate professional status, that changes the game, because then you can use that passive loss on any active income. So W-2 income. Mm-hmm. You could carry that over to your 1040 return. That's why if you have the ability to get the real estate professional status, I highly recommend it. And I also have clients that, they have full-time W-2 jobs, but their spouse claims real estate professional status, and they're doing a joint tax return, so they can use these losses on their W-2 income as well. So
right. So that's what Lee and I did our first year of marriage. I was still working a W-2 job, and I was a part-time real estate agent, but still couldn't qualify quite enough to be a real estate professional. But we got married. Lee is a full-time real estate professional. So we were able to write off against my W-2 income, because we can now use our passive losses against passive and active income. Mm-hmm. So
then, does the depreciation offset other passive income outside of that individual deal? So if you have other forms of K1 passive income, can you use that to depreciate it?
Typically not. It typically goes against the income from that specific asset.
Okay. Yep. Mm-hmm. That makes sense.
Got it.
All right.
Cool. All right. We have, let's see. I'll get you one more slide, and then we'll get to these questions. This is your contact information. And yeah, thanks to you, Dave, for going over all this with us. And there's Dave's email address and his phone number. Take a shot of this slide. If you want to get a hold of him, ask some more questions after the presentation. We will get over to these questions and cover these real quick. But make sure that you take down Dave's information and reach out to him if you ever needed his services, for sure.
And I will put it in the chat as well. But I really appreciate the opportunity to speak to the group. Cost segregation is a great tool and tax strategy that should be looked at. And like I said, we put together analysis all the time for prospective clients. We can get numbers to you in a day or two, and that way exactly what the benefits will be. So don't hesitate to reach out if there's any questions that this might be a potential fit.
Perfect.
Awesome. Well, we're going to run through. Thanks, Dave. Please take a moment to gather Dave's contact information. And Dave, also, if you don't mind, throw it in the chat. So then they can just copy and paste it.
He's going to do it.
He's going to do it. All right. Yep. Now, all
right. So the first question we already got, does depreciation count as a write-off for all of our income, or just passive? Like we said, it's passive losses for passive income, unless you're a real estate professional. Let's see. Explaining recapture after the property sold. We talked about that. How do you know if a cost segregation's already been done? Well, so these don't carry over from owner to owner. So it's basically you paid for the report and you applied it under your taxes, or you haven't. Yep. So
even if a prior owner did a cost segregation, the new owner is eligible to do a cost segregation once they take ownership as well. So it's not a one-time thing, on the building. It's based on the ownership.
Yeah, which is really interesting because, if the previous owner already captured a bunch of depreciation for the roof or, all of that, then, you sell. Well, I guess that's where the recapture kind of helps. It's like, hey, they recapture what they didn't use, and then, you kind of started from scratch, but still is not perfect. So I don't know. It's interesting to think about. And if you're like an LP, like if you're like investing into a deal passively as a limited partner, and you're not sure if a cost segregation study's been done, just reach out to your general partnership team. Yep. Reach out to your sponsor, whoever brought you into the deal, and they'll let you know. Okay, most syndication models are held for 5 to 7 years. Does this specifically for cost seg? Yep, we talked about that. The 5-year bucket.
That's not the only reason why it's a 5-year hold. Most syndicators design the investment as a 5-year hold because most limited partners want to have access to their capital more regularly than, let's say, if I said, hey, invest your dollars into this project that we're doing, but it's going to be tied up for the next 20 years. That would probably be a very difficult decision for you to make and say, I am okay with having my $100,000 invested into this asset for the next 20 years without having the true control over whether or not that property gets sold, if, when, or how.
Or the ability to withdraw it.
Yeah.
And also some debt structures, the debt structures that we like are 5 years, 7 years.
That's why. Yep. Is agency debt, which is the only type of debt that we utilize for our syndications, is 5-year debt, 7-year debt, or 10-year. So we only do 5, 7, or 10-year timeline projects.
All right. Next question. Will the syndication produce the necessary documents for having our CPA account for the depreciation? Yes, it comes on your K1. So all these losses that the cost segregation study are, providing for us, they're distributed via the K1 during tax time from your general partnership CPA team or whoever's handling the taxes for the deal.
It's like a Schedule E. So if any of you are, small property owners, normally you'll do like a Schedule E for your rental property holdings, theoretically. So it's like just adding another line item on there.
Yep. And we had another question. Is it just a paper loss on their K1? Yep, it absolutely is. Yep. So did you have something to add, Dave?
No, basically, how the deduction works is it's based on the percentage of ownership. So it's divided evenly between the ownership, and you'd get that percentage of the cost segregation benefits that you could apply to your K1.
And even as a limited partner, you are an owner of the real estate. You have a percentage that your share is allotted for your investment in the property. So that's why you get to, take advantage of this. So how do I explain these tax benefits to an LP investor who has a W-2 or runs their own business? Kind of what we just said.
Yeah.
Like you're going to get a paper loss K1 at the end of the year that you can apply towards passive gains.
Yep. Towards
like passive real estate.
Yeah. And into the future for up to 20 years.
Yep. Exactly.
Yeah.
Let's see. What does it cost to run a cost segregation analysis?
We didn't cover how much a normal average
what's
fee
the price?
is.
Yeah, it really varies by the scope of the project. A single family house is going to be different than a 280 unit condo. That's going to be different than a 1 million square foot warehouse. But what we look at is the type of building, the square footage, the location, and typically on the smaller building size, it's probably about $3,000 up to $10,000-12,000 for a larger building. The nice thing is the fees for the cost segregation is also tax deductible, so you do get a break on doing the actual process as well. But like I said, we'll give you in that analysis. I just need some basic information on the property, like the address, the purchase date, the purchase price, and the square footage. And then I can put together numbers that will list out exactly what our fee would be. That way, you know, ahead of time, our fee versus the benefit.
Yeah, and that's really nice. That's really something great to point out is like you provide this like, hey, here's kind of what we can get you, and here's how much it's going to cost. And then correct me if I'm wrong, but you've actually offered several different like in-depth analyses, so you can see like, hey, if we do like a light scope one, you'll get this much and it'll cost this much, or if you do a heavier detailed one, it's going to cost this much, but you might get this much, right? You have different levels of it.
Yeah, so for smaller structures, you know, a smaller single family house, we can do a limited scope project where we're just utilizing pictures and building plans, those types of things to do the details. On larger buildings, we like to have a site visit where one of our engineers will go on site and document the building, just because, you know, a larger building is going to have a lot more to itemize out. So the benefits are a lot better for when our engineers are there. But we do have a couple different options.
For sure, for sure. I wanted to make sure that people knew that there was a couple different options as far as pricing goes and benefit goes. So next question, can a cost segregation analysis be performed on an international short-term rental?
Yes, depending on the country, we do have an international team. So I don't have the full list of countries that allow cost segregation, but just reach out to me and I will track down the information that you need. I know we do work in South America, England, obviously Canada. So I also have a lot of international customers that own US properties, and they're able to utilize the benefits that way as well.
Interesting. Let's see. This is more of a CPA question. Can you use the depreciation to offset conversion of an IRA to a Roth in a given year, given tax year?
I don't believe so, but you'd certainly want to check with your CPA. Typically, it's when it's a passive deduction, it applies to that passive income from the property.
Yep. Yeah, let's see. Do you possibly see cost seg going back to 100% after 2027? A little speculation.
That is the $1 million question. Our fingers are crossed, but yeah, there's a lot that needs to happen on both sides of the aisle to agree to something like that.
For sure. And then our last question is, will the depreciation on the K1 be able to offset the 1099 income that I make as an independent contractor? And again, CPA question, but likely I would say it's going to depend on if you're a real estate professional or not, because that sounds active to me.
Yep, exactly.
If you qualify as real estate professional, that changes everything. But it sounds like active income. So I doubt that a passive loss would offset your active income in that way. Yeah.
But if you're a real estate professional, then it might be all right. All right. So that's all of our questions. Thank you so much, Dave, for being here tonight. This has been really educational, really great for our group.
Yeah, great questions. So thanks for everyone for paying attention. And again, Lee and Megan, thanks for having me.
Yeah, absolutely. Yeah. So we'll finish up with a couple last slides. You know, if you have $50,000 to invest and you want to get started investing in real estate, what are your options here? You know, you can buy a single family house, or not a very big one, probably not in a very good neighborhood. Or you can invest in a syndication and be part of a part owner of something like that photo right there, a large apartment complex, which can take advantage of large in-depth cost segregation studies for tax benefits. So this is specifically what Lee and I do. We put together syndications. We find, poorly managed property. We purchase them. We bring in passive partners, and we execute a value add business plan in order to increase the quality of the apartments, increase the quality of the neighborhood, and increase the quality and the value of the asset, so that when we sell, everybody wins. The tenants are happier, our investors are very happy, everybody's very happy. So that's what we do. We partner with people all the time who have $50,000 and they want to become an owner of real estate without having to ever unclog a toilet.
Yep. Don't have to sign on any debt. Don't have to plan to, have phone calls while you're on vacation for your, your anniversary trip. And
you don't have a tenant call you at 1 a.m.
Yeah.
because their toilet is leaking.
No.
Which that just happened to us last week.
Oh my gosh, it happens more regularly than you would want to hope.
Yep. So how does the syndication work? So this is a very basic drawing. But basically, hey, there's an LLC that owns the property. And then there's the active team, which is the team like us. We're the general partnership. We are managing the business plan. We're managing the entity. We're signing on the debt. We're taking on the risk. We're raising the capital. We're putting together the business plan. And we're making everything happen. We are actively managing the asset. And then our passive investors, our Class A members, usually there's a preferred return where they have to make a certain percentage, typically 8%. They have to earn that 8% before the general partnership team makes a penny.
Yep.
And there's only 4 little LPs under this, but typically there's a lot more. This just for the sake of the slide.
Picture there being, 50 or more individual LPs who are minority shareholders on a large scale property, giving you the opportunity to invest in a property that truly is scalable and can be drastically changed in value by making dozens and dozens of small tweaks.
Yeah, it's economies of scale. It's, with a single family house, it's 100% occupied or 100% vacant. And that roof is going to cost a lot of money when it's got to be replaced. Or an apartment complex, you've got 8 units under one roof. If one of those 8 units is vacant, it's not a huge deal to your cash flow. And preferably you have 10 of those 8-unit buildings.
Oh yeah. That's the problem with 8 is you're still 12.5% vacant if one of them is empty. So that's why we only buy 100 plus unit apartment complexes. So that means that if we have one move out, that means we're still 99% occupied. I mean, before we're at a place where we're below 90, you have to have, 10 vacant units in a property that's 100 units or larger.
Yes. And another reason that we love a 100 unit or larger property is a property of that size can afford to have on-site full-time property management. Someone there on a Saturday night, making sure that nobody's getting into trouble, making sure that the community is safe at all times, and, just giving the attention and actually what the property actually deserves. So what we found is, when you have properties that are smaller than that, 30, 40, 50, you got a part-time property manager giving it part-time attention, and a property just needs more than that when you're getting into that big of a community. So that's why we focus on this size.
Guess what happens when you buy the smaller property? Who makes up for the part-time work when you have a part-time manager?
You do.
The owner. So now you are a part-time property manager yourself. So
we say all these things from experience, folks.
Yeah.
So, and that's the thing too, is a lot of people just like us, we got started into real estate while we still had W-2 jobs, and so we were just doing this part-time, swinging hammers at night and doing our day job during the day. And, really, if you're really good at one thing, you should do that thing that you're really good at. Yep. And like Lee and I were not professional carpenters.
No.
Lee was actually a professional property manager, which is why this makes sense.
Yeah.
But, we both have real estate backgrounds, but, typically most people that are getting into real estate might not. They might have a W-2 job. They might be into a, halfway through or further into a 20 or 30-year career. You can still invest passively and keep doing what you're doing and not have to worry about putting in 4 to 5 extra hours at night or all your weekends, installing click-lock flooring.
The riches are in the niches, and you should stay focused on doing the one thing that you do best and know and are a true industry professional at. Megan and I are true industry professionals when it comes to commercial multifamily real estate investing. That's why we love partnering with folks like y'all.
Yeah. And this is all we do now. And, you know, we've been doing this since 2017. That's when you got started as a property manager. So, you know, we've seen a lot. But other things, you know, other things that are great about investing in real estate, the cash flow, you know, that's that monthly check. We were talking about the preferred returns already, appreciation, the asset. The great thing about commercial size real estate is it's driven by its net operating income. It's not driven by what your neighbor sold for. So we can reduce expenses, increase income. We're going to raise the value of the property, which is appreciation, which everybody shares in at the sale of the property. Next, what everybody's here for, tax savings. Get that K1 that shows a loss. Get it to your CPA. Save some money. That's not something that you're going to get in the stock market. No. You sell that stock for a profit, you're going to pay taxes on it.
You better believe it.
You're not going to get a K1 loss for, you know, unless you actually lost money in the stock market. And then nobody really wants to do that either.
Yeah, but it happens.
Yeah. And best thing about being passive is obviously you don't have to worry about managing the business or, you know, becoming a landlord. So with that being said, there's two kinds of LP investors because there's two kinds of syndications. You've got your 506C, which is where it can be publicly shared and we can market. And with that, you have to be an accredited investor. So that's someone who, you know, has a certain amount of net worth or earns a certain amount of money every year. If you have questions about that, you'll definitely want to look it up on SEC's website. But hey, if you're not accredited, you can still invest passively. You just got to get to know someone who does these things.
Us.
Yes,
First.
because non-accredited investors, they can invest in friends and family deals, which is what a 506B is.
Yep.
So they're not publicly marketed. You're not going to go on Facebook and see an ad for a syndication that's a 506B.
Nope.
But what you can do is get to know people like Lee and I, and then we get to know what your investment interests are, what you're kind of looking for. And then when we have an opportunity, we can specifically give you a phone call and have that conversation about you investing, because now we know you could be a friend and family investor. So if that's interesting to you, if you don't know if you're an accredited investor or not accredited investor, even if you are accredited, still,
in order to invest in a B, you do still have to have the relationship established ahead of time. So let's get that relationship started.
Yeah.
To a substantial relationship. We define that by having 3 separate phone calls. We're going to have one extended long phone call that covers all of the checkbox items that we have to check in order for us to believe that we have a substantial relationship that has been that process has been reviewed and approved by our legal counsel. So in order to invest with us on a 506B syndication, have a substantial relationship ahead of time, reach out, schedule a call with us. But for all of you who are accredited investors, several of you in the room are already in the know on this project that we're working on. I've alluded to it a couple times, but in Atlanta, we have an amazing 144 unit townhouse apartment complex that we are currently raising capital for today, and we're set to close in the coming weeks. Would love if you're an accredited investor to, schedule a call with us. We can go through the review of the deal. We actually have a webinar scheduled for tomorrow.
Thursday.
Today's Tuesday. Day after tomorrow. For that webinar, we would love to have you there. If you'd like to learn about that individual project, I have the link to it in the chat right now to our cash flow portal. So feel free to please click the link, review the initial deal, and potentially attend the webinar tomorrow. There is a YouTube recording of it day after tomorrow. There's a YouTube link to it as well in the cash flow portal if you want to watch a recording and not have to, or if you're not available to attend the day after tomorrow's webinar.
Yeah. And a couple last housekeeping items. Again, this webinar is recorded. And if you want to access it, the link will get emailed out, or you can go to our YouTube channel. We have done multiple of these webinars, these Make It Happen multifamily webinar series webinars, talking about all kinds of other topics. We had an SEC attorney on. We had audience member Sam Passanisi, who's sitting in the audience right now. He was on talking about being a limited partner and vetting vetting syndication teams. We've had lots of great guests with lots of great information. So check out that YouTube channel. You'll find all of our recordings if you want to learn more in your own free time. So
as well as access to the Tours and Pours virtual event that we do and post on YouTube as well. So check out our YouTube channel. You find us at Lee Fjord or Lee Fjord.
Just search for Lee Fjord and you'll
find it right away.
Perfect.
So anybody who has not had a chance to collect Dave's contact information, please do now, and then reach out to him, get your cost seg study estimate in hand. He can usually turn it around in pretty quick, 24 48 hours, and then you'll know what you're getting yourself into.
Yeah. All right, y'all, thank you so much for your time tonight. We appreciate every one of you for joining in, and we'll see you next month.
Yeah, let's all give Dave a nice round of applause. Thank you, Dave, for coming and giving us your time.
Thank you, everybody. It was a pleasure.
Yeah, thanks, Dave. Have a great evening.
All right. Bye, everybody.